Welcome to the Northbound Wealth Podcast. All opinions expressed by me, my co-hosts, or my guests are solely our own opinions and do not reflect the opinions of Northbound Wealth Management, LLC. This podcast is for informational and educational purposes only and should not be relied upon for any investment, tax, or legal advice, or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management, LLC may maintain positions in the securities discussed in this podcast. Hello to the Northbound Wealth State of the Markets presentation for 2025. Excited to have you here today and look forward to sharing this important information with you. As you can see, we're going to focus on 4 key questions. The first question is, how did stocks perform in 2024? The second, what drove market performance in 2024? The third, where are we now? And the fourth, what do major financial firms forecast for 2025? Let's begin with a look back at Wall Street analysts' initial predictions for the stock market's performance in 2024, how stocks actually performed in 2024, and some of the factors that drove that performance. The S&P 500 closed at 5,881.63 at the end of 2024, a gain of 23.31% above most optimistic expectations of the major Wall Street analysts. There may be several reasons for this. One reason may have been widespread concern among economists that a recession loomed in 2024, which didn't materialize. Other Wall Street strategists were concerned about valuations, while some felt that corporate earnings were likely to disappoint. All of this sounds familiar, but it's because many of the same dynamics were in play in 2023, another year in which market strategists also underestimated how well the stock market would perform. Remember, the S&P 500 Composite Index is an unmanaged index that is generally considered representative of the U.S. stock market. Index performance is not indicative of past performance of a particular investment. Individuals cannot invest directly in an index. Past performance does not guarantee future returns. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. Also, forecasts are based on assumptions and are subject to revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from expectations expressed in the initial forecast. In the following slides, we'll discuss the factors that affected stocks over the past year. As you can see, stock prices moved higher in 2024 with only a few dips along the way. I want to draw your attention to a few plot points on the graph because they highlight the key storylines that drove the stock market in 2024. The Consumer Price Index stood at 3.4% at the start of the year, indicating that inflation and the Fed would be dominant market-driving factors. While stocks took a breather in April, the S&P 500 continued to rise through mid-July. Stock prices started trending lower in late July on unemployment concerns. But the rally kicked in late August when the Fed publicly stated that the time had come to adjust its policy. At its next policy meeting, the Fed cut rates for the first time in 4 years. Then, in early November, election results came back decisively and quickly, which helped spark a post-election rally. By December, it was looking like the Fed had made considerable progress towards a soft landing with low inflation close to its 2% goal, while gross domestic product growth remained upbeat. The S&P 500 Composite Index, again, is an unmanaged index, and it's considered representative of the U.S. stock market. Corporate earnings are one of the factors that drive stock prices over the long term. As the chart shows, the earnings growth for the S&P 500 companies has emerged from what market watchers call an earnings recession. That is, when there is at least 2 straight quarters of negative earnings growth. As you can see, earnings growth improved steadily over the past 5 quarters, starting in the third quarter of 2023. Although the 5.8% earnings growth rate in Q3 of 2024 was below the prior quarter's earnings growth, it was still very close to Q1 2024 and well above Q3 and Q4 of 2023. So as consumer spending picked up in the third quarter of 2023, companies recorded positive profit growth for the first time since the third quarter of 2022, which was a rough year. What began as earnings rebound, driven by narrow section of the market, broadened out over time. Let's spend a little time getting a broader view of the economy in 2024. Last year, investors and consumers cheered on the U.S. economy while also holding their breath, fearing the possibility of a recession. Gross domestic product started out tame, but grew more robust through the year as companies continued to post solid results. As the economy kept humming, the Fed and market participants closely watched inflation. After falling to 2.4% in September, to many observers' dismay, inflation bounced up to 2.7% in October to kick off the fourth quarter. Small cracks in the economy began to emerge as the year went on. As you can see from the table, GDP growth eased slightly in Q3 and is forecast to slow even more in Q4. The unemployment rate began 2024 relatively low, but has steadily crept up this year. Consumer sentiment started the year at all-time highs, but has fallen off a bit since then. And while home builder sentiment has fallen off each quarter since the start of the year, more inventory and lower mortgage rates have helped sentiment stage a modest rebound in the fourth quarter. Despite these down-sloping trends, the good news is that many of these measures remain strong by historical standards. While the pace of inflation has ticked up slightly, it's still historically low. Consumer sentiment remains strong, and as does home builder sentiment. In 2025, as the Fed has signaled its dual mandate of keeping an eye on both inflation and jobs, so expect the Fed to focus on both in 2025. Let's begin with a look back at Wall Street analysts' initial predictions for the stock market's performance in 2024, how stocks actually performed in 2024, and some of the factors that drove that performance. So to create some context about where the economy stands today, let's start by examining where we stood 2 years ago, in January of 2023. At that time, monetary policy was tight, inflation was elevated, and higher interest rates were dragging down the housing market. 7 of the 20 indicators were red and the rest were neutral, with no green to be seen. There was widespread belief that the recession was imminent. No one knew if the Fed would adjust rates, if the labor market would remain resilient, or if consumer spending would continue to hold firm. In short, the outlook was murky. Now let's take a look at January 2024, 1 year ago. Notably, monetary policy, consumer spending, and corporate profits, inflation, housing, mortgages, interest rates, the yield curve, and the leading economic indicators are all now neutral. In all, 17 of the 20 indicators are yellow, while the remaining 3, international economic outlook, equity market valuation, and geopolitical risk, are red, but still no green. As we look where the economy stands now, nearly half of the 20 indicators are green. Among them are monetary policy, the labor market, and inflation. Consumer confidence has grown, corporate profits are up, and business outlook spending is positive. 9 indicators remain neutral, while only 2 remain red: equity market valuation and geopolitical risk. Let's examine one of those speedometers a little more closely, the Leading Economic Index, or LEI. This index includes 10 components ranging from stock prices to manufacturing orders. This data may give a clearer view of where we are when examined together. As this chart shows, the outlook has trended lower since early 2022. The LEI has been an accurate indicator in anticipating the 3 recessions since the year 2000. However, it appeared to signal a recession for 2023 incorrectly. In fact, GDP growth rose even as the LEI was painting a weaker economic picture. In November 2024, the LEI posted its first monthly gain in over 2.5 years. It's too soon to tell if this upward trend will continue in 2025, however. The Conference Board, which published the LEI, cites a number of factors that underscore the indicator's direction, including a rebound in building permits, higher stock prices, improvement in average hours worked in manufacturing, and a drop in initial unemployment claims. So, while no economic indicator is ever 100% perfect in predicting the economic future, the LEI remains an important input into developing our views about the economy in the coming months. Remember, past performance is not an indicator of future direction. And when we review charts like these, history can kind of suggest where the economic cycle is but it's just an estimate and a forecast, and they're based on assumptions subject to revisions. Geopolitical tensions are always a concern and are often an unpredictable headwind to the economy. The ongoing Ukraine war and Middle East unrest are just two examples that threaten to unsettle financial markets. Another possible headwind is a resurgence in inflation. We got to watch that. While the latest consumer price index reading has been between 2 and 3% in the fourth quarter of 24, any change in momentum may be a concern. If inflation does resurface in 2025, that may influence how the Fed approaches interest rate adjustments. Another possible headwind is labor market weakness. While this has taken a back seat to inflationary concerns, keep in mind the Fed has the dual mandate of pursuing the economic goals of maximum employment and price stability. In the second half of 2024, the Fed shifted its focus to the employment situation and away from inflation. The labor market will be an area to watch in 2025 for sure. While recessionary fears did not materialize in 2023 or last year in 24, as many feared, there is some concern about an economic slowdown in 2025. Consumer spending, corporate earnings, global economic weakness, especially in China, and the labor market risks are all recessionary pressures to keep an eye on. There are a number of potential tailwinds that may support the financial markets in 2025. One possible tailwind is artificial intelligence or AI. While AI was a steady influence in 2024, some see continued interest in AI throughout 2025. There are a couple of reasons. First, AI-related concepts have more room to broaden out across the economy. While most of 2024's AI was driven by tech companies, in 2025, many expect advances in industries outside of Silicon Valley. Second, if AI turns out to represent a quantum leap akin to the Industrial Revolution, there may be a lot more room for growth, especially if AI drives productivity. Another potential tailwind may come from a jump in the form of improving corporate profits as companies across all sectors and industries embrace AI. It's hard to think of tailwinds without thinking of the Federal Reserve and its shift to monetary easing last year. As the effects of looser money supply continue to filter through the economy, Fed policy could be a potential tailwind in 2025. Before discussing the 2025 forecasts, let's examine this chart to see where stock prices trend against historical averages. The most common way to do this is to look at the PE or the price to earnings ratio, which measures investors' willingness to pay for a company's earnings. Looking at the dotted line in the middle, you can see that the PE ratio for the last 30 years is, on average, 16.90. You can also see that the PE moves quite a bit with a peak near 1999 and a trough in 2008. The chart shows that the PE ratio was over 22 by the end of November. Does that mean stock prices will head lower or climb in the months ahead? While a PE of 22.2 is more than one standard deviation above the 30-year average, it's still a difficult question to answer, but it's fair to say that past performance doesn't guarantee future results, and the return on principal value of stock prices will fluctuate as market conditions change. So what are the forecasts for 2025? Let's begin with a look back at Wall Street analysts' initial predictions for the stock market performance in 24 and how stocks actually performed in 24 and some of the factors that drove that performance. Before discussing Wall Street analyst predictions, let's examine some important inputs that may impact the stock market's direction in the coming year. As many of you know, corporate earnings may be a key driver of stock market performance in 2025. And frankly, things look pretty good so far as we're almost through the first month of January. According to FactSet, a leading financial data and analytics firm, earnings are expected to continue trending higher in 2025. While that is a good sign, it's also difficult to say how much of that earnings growth expectation has already been priced into stocks, especially in light of their current valuation level. Estimating quarterly earnings is difficult, but such estimates can help guide decisions about what price to pay for a stock. If earnings are healthy, it may support higher prices. Conversely, should earnings come in short of expectations, it may put downward pressure on stock prices. It's important to remember that forecasts or forward-looking statements are based on assumptions, subject to revision without notice, and may not materialize. And if we've learned anything about the past couple of years, the outlook for financial markets can change quickly or be completely inaccurate. The Fed's decisions about interest rates may have some influence on stock prices in 2025. One tool traders look to understand where rates may be heading is the CME FedWatch tool, which analyzes the probabilities of future target rates as implied by the 30-day Fed funds future pricing data. So if we look at where the market thinks the Fed is going, we see that the market believes there's about a 45% probability of the federal funds rate falling by 25 basis points or a quarter percentage point by the end of June. In late December of 2024, the Fed funds rate was 4.25% to 4.5%. Traders also see a 20% probability for rates to remain unchanged within the first 6 months of 2024, while there is about a 22% likelihood of a half percentage point cut. There is also a 4.4% chance that rates will fall 3/4 of a percentage point and less than 1% chance the Fed will cut rates 1 full percentage point by mid-year. The Fed's fund signaling in Q4 of 2024 of a more cautious, hawkish approach to interest rate adjustments means the next 6 months, or the first half of 2025, may be quite different than the past 6 months with respect to Fed policy. Keep in mind the CME Group's table changes daily. Probabilities are based on assumptions and are subject to revisions. And financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations expressed in the table. The data from this tool does not constitute investment advice and is not a personal recommendation from CME Group. Economic forecasters surveyed by the Philadelphia Fed in the fourth quarter updated their outlook for Q4 2024 and all of 2025. They substantially increased their expectations for Q4 2024 real GDP growth to 2.2% from 1.7%. In 2025, they anticipate positive growth each quarter and are forecasting 2.2% real GDP growth overall for the year. So at this point, no recession appears in the forecast. Interestingly, their unemployment rate projections remain essentially flat throughout 2025, with only a very slight upticks in Q2 and Q4. It will be interesting to see how or if the economic growth influences the unemployment rate. I've said this before, but it's important to remember that forecasts are based on assumptions and subject to revisions over time. Aside from interest rates and inflation, one of the most critical factors that may decide how the economy and the stock market do in the new year is the health of the consumer. So consumer spending represents about 2/3 of the American economy, and if consumers pull in their spending in 2025, it could have consequences for the markets. Now, looking at Q4 earnings for a lot of companies, that's not the case. As we see in the chart, the amount of liquid wealth has declined over time, while credit card delinquencies have trended higher. Will the combination of shrinking liquid net worth and the rise in credit card delinquency influence consumer spending habits? That's difficult to answer, but the consumers have been known to surprise the experts, and frankly, I don't think that's going to happen. Among the biggest questions investors have heading into 2025 are, at which meetings might the Fed adjust interest rates, and does the Fed still see inflation as a concern, or has its focus shifted to unemployment? I will tell you that today, on January 29th, the Fed did have a meeting, and they're not going to be in a hurry, to quote Jerome Powell, to lower interest rates. So, as the Federal Reserve strives to meet its dual mandate of maximum employment and stable prices for the American people in 2025, the FOMC meetings are where those decisions will be made, so we'll be tracking that information very closely. So, what are the major financial firms forecasting for domestic stock prices in 2025? Analysts are predicting a relatively bullish year for stocks in 2025. However, unlike the past 2 years, you'll notice a tighter range in these forecasts, running from 6,500 to 7,000 on the S&P 500. The S&P 500 closed at 5,881 on December 31st, 2024. This tighter range of sentiment may be attributed to many of a variety of issues. Will geopolitical tensions hold back the market momentum? Will the Fed continue to adjust rates or tap the brakes until it is more confident that inflation is under control? Will the economy see a soft landing or slip into recession? How will corporate reports look in 2025? While these were all issues that strategists wrestled with in the past, there seems to be greater optimism and less divergent opinions. Also, with the Trump administration in, there's some concerns about the way they approach the economy, which is what the Fed is kind of politically engaging in as they see the inauguration happen on January 20th and a lot of agency appointees going through the approval process. So it'll be interesting to see how this all plays out. Remember, this particular picture includes a forecast. So it's important to remember that forecasts are based on assumptions subject to revisions and can change at any time. And there's a lot of different particular attributes that go into this forecast. So keep that in mind. All right. So anyone that knows me understands that I love discipline. I want to end our discussion with a word on the importance of investment discipline or sticking with your investment strategy. The potential of stocks to help build wealth over the long term may be challenged when investors move in and out of the financial markets. If we look at this image, we see a direct correlation to the probability of having positive gains in stocks with the time such investments are held. So, for instance, over the last 96 years, 73% of all one-year periods had positive returns. However, if we travel out to longer holding periods, we see the likelihood of investment success rise to 84% for 3-year periods, 88% for 5-year periods, and 94% for 10-year holding periods. In this illustration, stocks are represented by the S&P 500 Composite Index, an unmanaged index considered representative of the overall U.S. stock market. Index performance is not indicative of the past performance of particular investments. Past performance does not guarantee future results, and individuals cannot invest directly in an index. Stock prices, return, and principal value will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. What can you do in 2025 to move closer to your goals? Here are some action items. If your life or personal situation changes, keep us in the loop. We want to hear about important family events like births and deaths. We also care about health issues, employment changes, and financial developments that may change your situation. If you find yourself thinking about new goals or reevaluating your priorities, share your thoughts with us so that we can help you pursue the life you most desire. On top of specific adjustments in your financial life, we also want to know how you feel about investment changes. These could be details like risk tolerance shifts or environmental concerns. Finally, review your estate documents, beneficiary designations, and other paperwork to ensure they're all up to date. A well-organized estate is one of the best gifts you can give to your family. We're here to discuss any financial questions or worries you may have. Our priority is always to help you make informed decisions and stay on track. Throughout 2025, we will focus on delivering the following. We'll keep you informed throughout regular communication. We'll manage your investments according to your personalized strategy. That is, if we have a client agreement in place and we're managing your money. And we'll remain abreast of economic factors and adjust accordingly. And if you're not a client of ours, hopefully we'll provide some insight and education and information on the Northbound Wealth podcast on a weekly basis throughout the year. So check that out on Apple, Spotify, anywhere you listen, YouTube, podcasts, things like that. We're there providing personal finance and investment information and education. So go ahead and check that out. But we'll keep going to the next segment. Thanks so much for your time today. I really appreciate it. As you can tell, I am passionate about helping you understand the markets. For more information and timely updates, again, please follow us on social media and contact us anytime. The Northbound Wealth Podcast is a great way to do it, or you can go to our website at www.northboundwealth.com. And you can reach us at 317-399-1107 on the phone. We will definitely be in touch with you, and we hope that you enjoyed the details we shared today. And if you have any questions, we'd love to get an email from you. You can send us an email at info@northboundwealth.com, info@northboundwealth.com. And again, as a reminder, check out our podcast, the Northbound Wealth Podcast, hosted by me, Brent Foster, and I go over a lot of financial information every week. And with that, have a great week, month, year. 2025 is going to be awesome. So enjoy and cheers. Thanks for listening.